In today's silver report, I wanted to focus on some earnings for the Federal Reserve itself. Their earnings for Q3 of 2022 just came out, and they are bad, extremely bad. Losses that top $1 trillion, and whose earnings statement shows that they own 48% of the entire stock of 30-year bonds. Why should this affect silver? Because the unit of liability of that bank that has lost over $1 trillion is the dollar itself. And though we like to say that the dollar has no backing, it does have backing. It is backed by the assets of the Federal Reserve System, which are falling in value as interest rates rise. And as that happens, the purchasing power of the dollar is going to fall. There is temporary strength in the dollar now, and that seems to be abating. And that temporary strength on the Forex markets is causing prices to level off a bit, but that is going to reverse when the Fed is forced to print money once again, which is not that far off, and could be triggered by the collapse of Credit Suisse, which has a $17.4 trillion derivative portfolio. It doesn't matter that it is now a sub $10 billion market cap bank. What matters is what's under the hood, and it's got over $17 trillion of derivatives under the hood, which is why it has to be rescued, because if it's not, it's going to cause a multi-trillion dollar domino effect. As this is happening, silver is breaking through its 50-week moving average, and gold is testing its 50-week moving average for the first time in many months. And what we missed last week during the Thanksgiving break was that the money supply came out for the month of October, and the rate of deflation going back to 1982, meaning the fall in the money supply on an annualized basis, is worse than it has ever been. And I'll show you the graph. FSM relative to the SIL Globex, forgot what it's called, the silver miners ETF. And we see here the candles are FSM for this past year. Since December 1st, 2021, the stock has been outperforming SIL handily, consistently above SIL, so it is an outperforming miner. And we see here at the lows, they kind of basically equaled out, but on the way back up, FSM has beaten SIL handily. SIL is down 27% about for the year, and FSM is up 7.18%. And true, it's not like this every year, but I believe that their acquisition of Rox Gold, which has now made them a gold and silver mining company, has stabilized the miner to some degree. And I think that's why it might be outperforming the ETF at this point. First of all, gas prices are down. Yes, they're down. And here is the main reason why. You see here the drawdown in the Strategic Petroleum Reserve, the SPR, from looks to be about 700,000 barrels or so to, what is it now? 300,000, whatever it is. It's the biggest fall in the history of the SPR. That's why gas prices are down. And who knows how much longer this can last, but this is not a fundamental fall in the price of gasoline, that's for sure. It's a political one. And now, what I said we were going to go into the earnings of the Federal Reserve, the bank whose liability is the US dollar itself. So you see here these little columns. They show here the cost, first of all, of Treasury securities. We have $5,873,710,000,000 of amortized cost of U.S. Treasury securities. And then the fair value in the second column, which is 5.186 trillion, and you have a loss there of $687 billion in the Treasury security portfolio. Add to that a $438 billion loss in the mortgage-backed securities portfolio, and together that is a $1.125 trillion loss on the Federal Reserve's balance sheet. So 1.125 trillion over 8.6 trillion, I think it's about a 15-16% loss of the entire value of the balance sheet. This is serious, folks, and it does matter. Don't believe anyone who says it doesn't matter because the bank is magical and it can just issue units of money. It can't. It can issue units of money substitutes. The Fed does not issue money. It issues substitutes for money, which is gold and silver. And as soon as those money substitutes die, none of these numbers matter anymore. And the higher their losses, the quicker the unit will die. Just like any other bank that issues a money substitute, if rumor has it that the bank is bankrupt, as what is happening here on this balance sheet in the numbers, then its liabilities become valueless as well. Now here, I juxtapose that previous earnings statement to the current holdings of 30-year treasury bonds, right? On the right here, you have bonds in the bonds category. This is from SIFMA, the organization that keeps track of all these treasuries numbers. On the Fed's balance sheet right now, here we have $1.490506 trillion in bonds. The bonds category includes the 20-year and the 30-year. The 20-year is relatively new. Most of these are 30-year bonds. So the Fed owns about 1.5 trillion of them versus 3.9 trillion that are outstanding. So this is about 48% of the entire stock of 30-year treasury bonds. So when the price of the 30-year treasury bond goes down, that's when the Fed's losses are going to be concentrated because they own half of the damn market. By the way, if we look back at the 2021 earnings for December 31st, 2021, we see that the Fed earned or had a gain of $128 billion versus this year a loss of $1.125 trillion. Those losses are going to increase as interest rates go up and up and up. And that will be reversed, of course, when they make the final pivot, but then the value of the dollar itself will plummet through the floor, and that's when gold and silver will really shine like crazy. And that's something I want to point out about silver. It looks like we are coiling between the 200 and the 50-week moving averages. This little dance right here between the blue line and the red line, this is another coil. It means that price is going to move strongly in one direction or the other. And as the dollar is falling, I believe it will be up. And another thing to point out here is that since the big jump of July, August 2020, right, from March to August 2020, when silver was about $11 and then jumped up to above 30, since that time, the 200-week moving average, this red line, has been steadily rising. Despite the falls in the silver price since 2022, that line is still rising, which means we're still on a gently rising slope of silver prices, even though it doesn't feel like it. But that's important to keep in mind. And if we break above this 50-week moving average, which I think we are going to do imminently, we could be starting another cyclical bull part of this overall secular bull market since March 2020. And this is being confirmed by gold here, which is also sitting between its 50-week and 200-week moving averages, also coiling at around the same levels. The 50-week moving average here is 1806, and just like silver, the 200-week moving average in gold has been rising steadily since 2019, or really 2018. It was flat in 2018 and has been rising ever since. And even the 50-week moving average hasn't moved much at all since 2021. So despite the fall in gold prices, the technicals are still quite bullish as far as I can see. And finally, money supply. This chart I have never showed to anyone before. It goes back all the way to 1982. I show the chart usually from 2006, but here is a long-term view of annualized monetary growth rates. This is the actual rate of inflation / deflation of the money supply, not of consumer prices. So you can see here that deflation on an annualized basis is extremely, extremely rare. It has only happened about 2 or 3 times in history since 1982, since Volcker started printing money after the big tightening cycle of 1978 to 1981. So we had deflation coming online here in 1992 and 1993. So why didn't we have a big crash then? I believe it was because the internet was making production a lot more efficient. So even in a deflationary money supply environment, you still had rising stock prices because earnings were going up and companies were really doing very well. And then you have here the deflation of 2008, where the money supply growth rate fell to 0, just below 0. And that led to QE1/2, which pushed the money supply growth rate up to about 17% or so. And then there was another deflation after the stock market had already crashed. So we'll scratch that one out. But here, you see the line here? Oh, boy. Well, this is the COVID printing. You can see how insane it was. Be way beyond any previous record. And then we have a break below the 0 line, meaning absolute deflation, money supply shrinking on an annualized basis, going below 0 here. And we had a tiny little blip up for holiday spending season, but now we are headed back down again. And seasonally, money supply does tend to shrink during the January, February point. We have serious deflationary forces in the banking sector, which is going to bring down a bank or two or all of them. And who is the biggest contender to be the first domino to fall right now? That is Credit Suisse. Let's take a look at what's under the hood in Credit Suisse. So this is from page 100, 300 something something out of 400 something something something. I don't remember the page number, but it's in the annual report. This is their derivative portfolio. This is in billions. So this number 14,555.3, that's $14 trillion. The biggest section of these derivatives are interest rate swaps, which go down in value as interest rates rise. And so this derivative portfolio is the real problem here. If Credit Suisse goes under, there's going to be margin calls. They're going to have to sell these things, and it's going to lead to the same thing that happened in the UK when there were forced margin calls that brought the whole bond market down, or the, what's it called, the gilt market, and then the Bank of England had to intervene. So if Credit Suisse is not rescued, the pyramid will come down. Credit Suisse will be rescued, and it will be rescued by another global round of money printing, which is soon to come. Exactly when, I do not know, but it is coming. The total amount of derivative instruments here is $17.4 trillion, which is enough to knock down the entire $600 trillion, or some say $1.5 quadrillion derivative pyramid that is rotting the financial world, and that rot is about to take over and kill it, which is a very good thing, because we have this thing called central bank digital currencies that are being born, that are in utero right now, and that they want to bring out into the open as soon as possible. One thing I wanted to make clear about these CBDCs is that we do not have to worry about them for the long term. They might come into existence and cause our lives to be living hells for a short period of time, as the government will have complete control over the monetary system, and there will be no escape, and they will know every transaction you ever make. But what must be emphasized here is that CBDCs are not fundamentally different from a monetary perspective from the digital dollars that are in your checking account right now. It is not a new pyramid. It will be another layer of the current pyramid. And when a king's throne gets shaky, the only thing he knows how to do is build it higher, which makes it even shakier. And so CBDCs will not stabilize the financial pyramid. They will make it even shakier, if they even make it to their birth, which I have my doubts as to whether they will. And so as terrifying as central bank digital currencies are, we do not have to worry about them as long-term enslavement, because they will not survive long before the public attacks it through hyperinflation and destroying the entire throne of the financial hooligans and thieves of the world.